Alright, for this video I want to go over a foreign 1065 partnership return example where we have a real estate LLC that is in the business of buying, renovating, and flipping the real property, right? So it's not a investor fund, it is not a real estate rental fund, it's an entity that's engaged in the business of buying and flipping real property. So I do have the 1065 sample in front of us with the K1, so we'll go through that. And we do have a set of financial statements for the company. So the balance sheet's over here on the right hand side, and then the profit and loss is totaled on the end here, but it's also broken out by the property, right? So if this would look familiar if you were doing this in QuickBooks and you had a separate class set up for each investment property, so you can track the costs and the sale price of each one, but then obviously everything is consolidated at the end and report as such on your tax return. And then the last piece here is a slide where we're going to cover the tax issues and then the fact pattern. So I'll start here and then we'll go over to the financial statements and then work our way into the tax return itself. So when we have a real estate flipping type business, whether you have a real estate flipping type business for tax purposes is really going to depend on the facts and circumstances and your intent. So when we think about real estate funds, there's really three categories, right? So we have the real property dealers, so these are the flippers, and then we have real estate investors, so these are more of a buy one project, kind of renovate it and hold it for a bit. You're not going to rent it, but you're not actively flipping a lot of properties, and so this is more akin to just being a real estate investor rather than a dealer. And then the last bucket is the rental real estate activity. So when we talk about real estate dealers, we're talking about funds or the business owners that are engaged in an active business of buying property with the primary intent of resale, right? So that they don't want to buy these and hold them for long-term appreciation. They don't want to buy them and hold them and rent them to a tenant. The idea is to buy it, quickly renovate it, and then immediately sell it, right? And then move on to the next project, or you're working multiple projects at one time. Now, what's important when you become a dealer is the real property assets are now treated as inventory, so they're not capital assets. And so what that means is that when you sell your real estate, there's no capital gain tax treatment, right? All the gains are treated as ordinary income or loss. So it's taxed at your ordinary income rates. It's also potentially subject to self-employment taxes, right? Depending on how your entity is structured. And there's no depreciation on the real estate, right? So that's another key point is a lot of people think, well, if I buy real estate for investment purposes, I could depreciate it. No, that's not the case here, right? If it's inventory, you're not depreciating it. So it just goes on your balance sheet as inventory. It's cost of goods sold. So the gains are ultimately going to be ordinary in nature. Now with the real estate investor category, this is kind of similar to the real estate flipping, but it's more of a long-term buy and hold strategy, and you're not doing it as frequently. Right, and so if you're in the real estate investor bucket, the property purchases are still treated as capital assets, right? So it's not inventory. So when you sell the investment, depending on your holding period, it could be long-term or short-term capital gain. And if you take losses on the sale, you still have capital loss limitation issues. Now, real estate investors might have the intention of being an investor because they want this more favorable let's say long-term capital gain treatment, right, rather than ordinary. So you might be thinking, well, I'm going to get into the flipping business, but I'm going to keep it in such a way that I'm just an investor, right? I'm not an actual dealer. And that's all well and good. I mean, there are strategies to make sure that you can find yourself in one category or the other, but your intent is important, but also overall facts and circumstances test. You have to really be careful here based on the activities to see which category you would fall into. And then the last one is rental real estate, right? So this is pretty clear, right? If you're buying a property and you're renting it to a tenant, well, it's no longer within one of those two categories. It's a rental real estate activity. So those gains or income and expense generally always report on the 8825. And so you have PAL, or passive activity loss limitations, but they could be ordinary. If you find yourself in a short-term rental situation and you provide substantial services. So this is, you kind of think of like your Airbnb, your short-term Airbnb type investments where you might have these kind of issues. All right, so now let's look at the fact pattern here. So the fact pattern we're working with, we have John, Jane, and Bill are forming a real estate partnership. And their intent and the way they manage it, they are buying, renovating, and flipping houses, right? And so the volume that they've done over the year puts them into that category, right? None of these houses are going to be long-term buy and holds. None of the homes are going to be rented to tenants, so they've determined that they are in this dealer category. Now, as far as the way it's structured here, we have John and Jane invest directly into the entity, and Bill decides that he's not going to invest directly as an individual, but he has this non-grantor trust where he's the trustee, and so he's going to invest funds via that non-grantor trust. And so we'll see that on the Schedule K1. Now, the ownership percentages aren't all equal. John's going to put in $125,000, Jane puts in $175,000 in cash, and the trust puts up $200,000. And during 2022, there's no distributions. John and Jane are actively participating in the business, and then Bill and that trust are just characterized as passive investors. So there's no material participation or active participation on the part of Bill or that trust. So during the 2022 year, what we'll see is the fund was set up towards the end of the year, and so they were able to purchase and renovate 4 properties. They were able to get 3 sold before the end of the year, but 1 is still being renovated at the end of the year and has not been sold. All right, so let's have a look at the financial statements for the company. So the balance sheet here on the right-hand side, relatively straightforward, right? They've got checking account and savings account, so this is the cash balance at the end of the year. Now in the inventory section, right, this is where you would track the purchase of the house and all those related costs, those inventoriable costs such as buying costs, renovation costs, cost of selling the property. All of that is inventoried, right? So all of that is part of your cost of goods sold when you sell the properties, and then what's reported on the tax return. No liabilities, right? So all this is just being cash funded, right? So the owners here are just putting in cash; they're not using any leverage. And then on the profit and loss side here, the totals here in this column, this is what's ultimately reported on the tax return. But for their purposes, they like to break out the different types of properties that they sell, because they obviously want to track their profit or loss on each property. So the revenue section is the sale price of the property, so when they actually sold it to that third-party buyer. And the cost of goods sold is all their money in on the deals, on the projects, right? So what did they originally pay for the house? All those other buying costs, taxes, utilities, the cost of the renovations, cost of labor, cost of sale, and then the other expenses down here. These are all those expenses that are really part of the entity itself, not necessarily on a per project basis, but they can be allocable. So for example, the accounting fees for the year, $1,500, they just allocated these evenly across the projects, and that's fine. Now, on the tax return, these aren't being separately stated, right? This is just for their own internal accounting purposes, which is okay, right? They can do it this way, and then everything is just consolidated and reported as one on the 1065. And then they do have some interest income down here, which again, they've just evenly split it for their own internal purposes, but the $33 in interest income is a separately stated item on the K1, and so we'll see how that ends up in the K1 as well. All right, so now let's have a look at the return itself. So page 1 of the 1065, so obviously we need to input information on the fund itself. This is an initial year return, so we've checked the box here in G1. We are operating on a cash basis, and we can because our gross receipts are under that threshold. And as far as the tax year, right, so the fund was set up on September 25th, and we're going through the end of the year here, December 31st. So principal activity is real estate, EIN for the company, date business started. Now, page 1, this is where we report income and expense from an ordinary trader business, right? So trader business income is on page 1. If you've seen other kind of real estate partnership returns, if you were looking at a real estate rental type fund, then page 1 is blank, right? And that's because everything is reported on the 8825. If you had a real estate investor type fund, again, the buy and hold on a more long-term basis, less of a dealer type fund, page 1 would also be blank, right? Because those activities are going to be reported on 8949 and Schedule D. But in this context, because we do have activities in real estate that give rise to a ordinary trader business, everything is going to be reported on page 1. So the income section here, the gross receipts from sales, so that is the total sale proceeds from the disposition of all the properties, right? So again, if we look at our financial statements here, this total sale of the property is 1.2 million. That's what's being reported on line 1A. And then the cost of goods sold section, attaching 1125, and so that is the 1,089,000. That is the total amount of cost of goods that we have across all the properties. So if we take a look at the 1065 and scroll down to the 1125, here's the roll forward, right? So inventory at the beginning of the year is 0, right? Because this is a first year fund, so we don't have any inventory carried over from the prior year. The total purchases, right? So that's the purchases of the homes themselves, right? So the total amount of homes that we bought during the year, the cost of labor that was inventoried, and then all those other costs, right? So we've attached a supplementary statement to get to the 186,825 number, and then we report the inventory at the end of the year per our balance sheet, 473,490. We can find that on the financial statements in our balance sheet, right? So there's our inventory at the end of the year. Again, this is the home that we bought that we haven't sold yet. We do have some costs into it, right? But the construction is still ongoing. So our inventory at the end of the year, 473,490. Our total cost of goods for the period, 1.08 million. And so that's how we get our cost of goods sold figure here on line 8, which is ultimately reported again up on page 1 of the 1065. All right. Now, once we have our gross profit, right, total income or loss, then we add all those other expenses that were not inventoriable costs. So we've added a statement, a supplementary statement for the 11,900, and that is the total cost down here. So we can see here the 11,900 are all these costs across all the properties, and so that is also a deduction arriving at our net ordinary income or loss. And then the next piece is, well, the interest, right? So the interest income, remember, when in a partnership context, there's a lot of items that have to be separately stated. So we have the line 1, ordinary business income or loss, that's coming through from page 1. And then our interest income is separately stated here on line 5. Now, when we have a look at the balance sheet here in the M1 reconciliation, we can see here reconciliation of income or loss per books with loss per return. Our net income or loss per books, 127,798, right? That's the number that we're pulling from here, right? So this is all of our ordinary trader business income, add the interest, and our net income per books, 127,798. Now in this case, we don't have any book tax adjustments. So if you had any book tax adjustments, we would see something entered here in lines 2 through 8, and we would have perhaps a different amount of taxable income for the year, but we didn't have any things like entertainment expenses. We didn't have 50% meals limitations. We didn't have any other kind of book tax depreciation, because again, we're not taking any depreciation expense. So that's why in this context, not always the case, but in this case, the net income or loss per books matches the taxable net income or loss that's passing through to the K1s. Now in the balance sheet, again, beginning of the year is 0, right? Because this is a new fund. And then at the end of the year, we reported the amounts that we have on our accounting financial records, right? So our cash, the amount of inventory cost there, that matches our balance sheet, and that matches the number on our 1125A, right? The cost of goods sold form that we just looked at. a little bit of credit card balance open there, and then the partner's capital accounts at the end of the period. In the M2 capital account reconciliation, we can see that we put in the $500,000, and that was split across the three investors here. So John's capital contribution, Jane's capital contribution, and then the trust contribution. That totals up to be the $500,000 figure. So that's reported there, and then the net income or loss per return, and then the ending capital account. So all that matches up nicely. So we know we're in good shape. Now, if we take a closer look at the K1s, we'll look at the first one here for John. So the amount of income being allocated to John is going to be 25% of the net income and other items earned by the partnership during the year. Now, with partnership taxation, right, special allocations allowed. You can get really creative with how things are allocated to the partners. In this case, it's a very simple allocation. The amount of income and expense allocated to each partner is simply a percentage based on the amount of capital they put into the company, right? So John put in 25% of the capital, 125 grand, so he's being allocated 25% of the net income or loss and other expenses, right? So K1's pretty straightforward, right, in this context, right? We have the ordinary income or loss up there on line 1, and then on line 5 we have the amount of interest, and then there's no other separately stated items. Now, remember, John and Jane are actively running the business, right? So their material participation, their active participation in the business means that it's likely subject to self-employment tax for them, right? So we are indicating that John's entire line 1 amount is self-employment income, right? So $31,941, and then the same goes for Jane. So if we jump down to Jane's K1, she's got the same, right? A little more allocation of the income because she puts in more money, but it's also self-employed earnings to her, right? Now, if we look at the trust, for example, the trust we are saying is not actively participating in the business. So because there's no material participation there, the ordinary income or loss, we're not reporting it as self-employed earnings. But, you know, when the non-grantor trust does its own 1041, you know, maybe it'll treat it differently, but from our perspective, it wouldn't be self-employed earnings to the trust. So $51,106 is being allocated because they put in 40% of the capital, so they have 40% of the LLC units. It is a limited partner, and so for those reasons, we are saying it's not earnings subject to self-employed taxes. Now, as far as QBI issues, right, so QBI is section 199 cap A, qualified business income. With real estate dealer funds, it is a qualified business, right? So we do have line 1, ordinary trade or business income. It's effectively connected income. And so we are reporting it as qualified business income for the investors. So we can see here the sample QBI statement for the trust. We have a qualified business, right? Here's information on the fund. The amount of qualified business income or loss allocated to the trust is $51,106, right? So that's the line 1 amount. And we are reporting it as not an SSTB, so it's not a specified service, trade, or business. Okay? All right, so I think that covers it for this return. Again, relatively straightforward. I think for real estate funds, it's really important to do this analysis, right? Make sure, are you actually flipping enough real estate to be considered a dealer, or are you just an investor? Because that is going to significantly change not only how everything is reported on the 1065, but you know, how everything is ultimately going to be taxable to the investors when these amounts are passed through on the K1s to their returns. So thanks for watching. Hope that was helpful. If you have any questions, feel free to leave me a comment below, and I look forward to seeing you again on the next video. Thank you.